Good day. Today was the RBI policy, and so I thought I will give you my take on the policy itself. So to start off, the market reaction to the RBI policy was on expected lines. That for 5 days the market had been rising up, expecting a CRR cut and no interest rate cut, and so that expectation was fulfilled. So buy on the rumor, sell on the fact. So the market today is seeing some profit booking and taking. But let's understand why the RBI acted and what does it give us a guidance for the future, right? So first of all, to understand the RBI's role, right? RBI has a dual role. One is to manage the inflation versus growth trade-off, and second is to manage the currency in a less volatile, regulated manner, not to target a currency rate, but not to have excessive volatility or overly going towards over depreciation or over appreciation. These are the two main tasks of RBI, for which they have in their tools an interest rate policy and a monetary policy, which is a liquidity, right? Interest rate policy is operated through the reverse repo and the repo, the rate at which the bank lends or borrows from the banks. And the monetary policy is about putting liquidity into the banks or taking liquidity out of the banks, which in turn translates into the economy. So, why was the market expecting this and what was the situation? So, I think one of the things was that the market, because of the low GDP growth, expected a favorable RBI policy. That's why the market had run up. At the same time, an interest rate cut was not expected. Why? Because inflation numbers have proved sticky because food inflation will be high. October 4 inflation came at 6.2 versus September at 5.7, and RBI's target is 4%. So way above that. So it was unreasonable to expect a rate cut from the RBI. But why a CRR cut was expected and it happened, and what does it augur? It's because of the monetary policy, and the monetary policy arose because of the currency actions of the RBI. Now, general liquidity in the economy has been good, but in the month of November, we saw a sharp drop in the banking system liquidity. Why did this happen? Because RBI had to buy dollars and hence suck out rupees to buy the dollar to prevent the rupee from depreciating too much. It only depreciated about 1.3%. The yuan and others have depreciated 2 to 3%. So compared to other emerging economies, RBI has done a very good job of managing the rupee's depreciation in a reasonable way. But whatever they had to do, they had to use their reserves, and naturally they had to suck rupee liquidity out from the economy. So there was a liquidity shortfall. But that being said, that doesn't need necessarily to lead to a CRR cut or whatever, because it's a past event. It's November is already over. But it's because in December 15th, the middle of December, you have advance tax payments being made. So corporates as well as individuals pay from their bank accounts advance tax. This goes into the government's coffers but doesn't come back into the system until the government actually spends it, which could take a month or 2 months. So there was an ongoing liquidity shortage, very apparent. Now what does RBI have in its monetary policy tools? It basically manages liquidity through auctions, V8 RRR auctions they are called, right? Reverse repo and repo. So that they do, which they do in ongoing basis, but they're not big enough to come and dramatically alter the liquidity. The second tool which they had in their hands is the statutory liquidity ratio. Each bank, when it gets deposits from the customers, 21% of it roughly it has to keep in government securities, earning whatever 6-7%, because it can't lend everything, because if there's a run on the bank, they will first liquidate this to make sure they're able to pay that depositor. So this statutory liquidity ratio is something that the RBI can alter, take it up, bring it down, do as per those things. But more immediately in a quick action system is the cash reserve ratio. The cash reserve ratio, which is brought down from 4.5 to 4 today, represents that 4.5% was the percentage of the deposit, net demand and time liabilities, that's what the word is called, at 0% interest with Reserve Bank. Now that's a huge amount of money, and just this 0.5% means 1.16 lakh crore rupees. Now that release is what the RBI has chosen to do because it has a multiplier effect. It not only helps sort out the liquidity because of it, but what happens is with the banking system, the RBI governor said today the banking system is very healthy, which means they are in a free situation to lend. Second, the credit deposit gap. Earlier, if you notice, the deposits were growing about 10 to 11%, the credit was growing at 17%. So there's a huge gap into the system of worry, and part of the reason why the bank stocks also reacted. But now the RBI governor says that both the deposit growth rates and the credit growth rates are more or less balanced, which means whatever fresh liquidity RBI gives to the banks can immediately go out as lending. So by doing this way, they are supporting the lending in the economy, and monetary flow into the economy will not be a constraint. So that's the second benefit of this. The third benefit comes to the banks from the fact that you're earning 0% on this 1.16 lakhs crore. So on average, if you take even 10% as the rate at which they can lend out this money, that's straight away 11,600 crores profit, or which they were having a loss earlier, is a benefit to the banks. So obviously, this is very positive for the banking system, right? So with this liquidity, then you can expect that the lending side of the economy will get support through liquidity. Banks, their profitability will also show an uptick, and overall it's good, right? So that summarizes the actions of the RBI on the policy. But there's also a lot of data which the RBI gives, which gives the market a direction for the future. So first of all, right, the GDP growth coming low, right? So the reason the market also didn't expect a rate cut or get RBI to do a rate cut, because nobody was worried about it. That's why the market also rallied. What? Because the October-November data which came out, auto sales at 32% in October, the PMI numbers for manufacturing and services both coming at about 57, 58, right? And the exports, both merchandise and service exports showing strong growth. All of these indications, and the specific sectors which brought down the economy were cement, manufacturing and mining, iron and steel, which are all related to the government capex spending. And because of the Maharashtra elections and the central elections, why this came on a back burner. Now, everybody expects, the governor as well as the market, that the government will go back into spending. So once that's happening, the GDP growth should pick up. So RBI's number for this quarter, October, November, December, is to up the GDP growth to 6.8. And then for the next 3 quarters, it's 7.2, 6.9, 7.3. So that means for the next year, RBI is expecting an average of 7%. Now this number can be looked at in 2 ways, right? The first is that earlier we were expecting 7.2 for this year, which RBI revised down to 6.6 today. That's the current financial year. But based on that 7.2, the expectation next year will be 7.5 or 8. Now that's not there, and it's now being pegged at a 7% level. So there will be some disappointment and some correction in terms of the growth rates on that. But mostly the market had already factored that in based on this. But more importantly, for the market, it's not just the GDP growth, but the nominal GDP growth. So we must also look at the inflation trajectory, which has 2 things for us. One, to tell us the nominal GDP growth, but second is to also tell us what is the future RBI actions likely to. So now from an inflation perspective, the first thing is that RBI, in their speech, they said that, the Rabi sowing has been very good. The Kharif harvest should come through in January. All of that should ease food inflation and all of that for the next quarter. But for this quarter, they have continued to retain the inflation expectation, October, November, December, at 5.7. Right? So this is a big uptick, because earlier they had kept it at 4.8 for this quarter in their previous policy. So almost by 1% they have upped the inflation forecast for this quarter, naturally because the food prices continue to be high. But from the very next quarter, that is Jan, Feb, March onwards, RBI is expecting inflation to be anchored at 4.5 for JFM, and April, May, June also 4.6. And then for the next following quarter, they are expecting the inflation to come down to 4. So clearly RBI expects all this food harvest and all to come through. They are expecting oil prices to remain stable at the $71, $72 levels for Brent crude. And so if RBI's direction holds good at a 4%, that's the target for RBI to consider rate cuts. So parts of the market are expecting a rate cut in February. I don't know, we'll closer to the date only we'll get to know. But if this trajectory holds good, it's not unreasonable to expect 1 or 2 rate cuts in the next year. So if that's the case, then that's good for the equity market outlook as well as good for the banking system and the rate sensitive. What are rate sensitives? There are banks and NBFCs obviously, but rate sensitives also include consumer discretionary, where people take EMIs. Consumer discretionary includes consumer durables, real estate, auto, all of these where they use EMIs to lend, as well as cyclical ones where the capex is dependent on the rate cycle, right? So all these should get a boost if this trajectory holds good. So that's one important thing to track. Right now, market can read positively. That's one aspect of the inflation forecast, that a couple of rate hikes, 25 or 50 basis points over the course of 2025 can be expected. Now we look at what this also means to the nominal GDP. So now for each quarter, RBI has got a GDP forecast and an inflation forecast. So the nominal GDP comes out to an average about 11.5%. If you add up these 2 numbers quarter on quarter, you will come to 12.5 for this quarter because of high inflation, then 11.7, 11.5, 11.3. So an average about 11.5%. So what I'm trying to say is that you have to anchor your expectations from the stock market to broadly the nominal GDP plus probably a couple of percentage points. So at 11.5, somewhere between 13.5 to maybe 14-15% should be the return you expect. Why? Because the market earlier was anticipating a huge pickup in the growth rate and had factored that in, and then we had a EPS downgrade and a correction which came also because the FIS pulled out because of US. But that correction and the downgrade have more or less matched. So now from a future expectation perspective, right, this should be the anchoring, and don't expect a 20-30% movement from the markets for the next year. I think an anchoring into a middle double digit number is more likely. And now when you look at which aspects of the market, obviously I've come to the rate sensitives as one aspect, but on a broader basis, right, one of the good things which has happened is with the correction is that FIIs who sold what? About 1.25 lakh crores over October and November, in the month of December so far, they've brought in 25,000 crores almost. So there's clearly a change in their assessment of India's valuation and the growth and the RBI's supportive measures. So this return of the FI, now I don't think that through December this will last at a very rapid pace, because second half of December, US and America, Europe, everybody goes on holiday for Christmas. So there will be very light trading and all of that. But come January, with the new allocations to be made for the new financial year, new year, I expect that the FIs will come back. There will be the positivity on the budget, and I think that the revival in the GDP growth will reflect in the EPS numbers, and hence you can revise forecasts. So FIS should come back, so this should be supportive for the large caps and larger mid cap. But at the same time, domestic liquidity should continue to be strong, especially from the 25,000 crore SIP book, which I see rising to 27 or even 30,000 by the end of next year. The key point there is that 13 to 15,000 crores per month of that 25,000 crore SIP book is coming in mid and small cap area sectors, either through direct mid cap and small cap and multi cap funds or through these sectoral funds. So what this means is domestic fund managers, because SEBI is very strict about the guidelines saying 65% of a small cap fund has to be in small cap stocks, only 35 can be in non-small cap. Same with the mid cap. So this means that a significant proportion of liquidity of the domestic fund managers will be utilized to buy mid and small caps. Now, which sector valuations will decide how they do that, but there is going to be buying support for mid and small cap. So my fund choice of pick for next year, anchoring this expectation in the middle double digit, is the multi-cap category, where the fund manager has to buy all the three cap curves, right? So I think that would be my primary pick, and that's what I would recommend to you all, to keep that as your anchor allocation to be in the multi-cap space. See, flexi cap, you're again still dependent on the fund manager taking this call, and most flexi caps tend to be heavily weighted towards large cap. So I would prefer a multi-cap over a flexi cap. The large and mid cap is also a good category to look at. Apart from this, this is a core allocation. As a satellite allocation, right, I would recommend you to look at the BFSI space. Why? Because I already spoke about how all of this is going to help the banks, both the CRR cut, the liquidity in the market, the fact that the pressure on the deposits is no longer so much there, the fact that the RBI governor said that the banking system is now very healthy, and you have the government spending, and the capex cycle means there's going to be financing needs. So overall, at the banking lending side of the BFSI space, the banks or small finance banks or private sector banks or NBFCs, gold loan companies, all of these should benefit. But there's also a right-hand side of the balance sheet, don't forget, right? Because India's per capita GDP has gone from 2,200 a few years ago to about 2,700. And this has been a very polarized, rich getting richer, poor getting poorer kind of a difference. So at the higher ends, and that's why you have a K-shaped recovery in consumption happening, is that those people are not only likely to spend more, which is good for the banking system because they'll take those EMIs and but they'll also save more. And so the savings side of it, which is one in insurance, both health insurance, general insurance, life insurance, then asset management companies who benefit through the SIP book, then you have wealth managers, distributors who raise this money, you have stockbrokers where retail participants are paying. All of these are going to benefit from this rise in per capita GDP that's happening. So I think that, and to top it all, if you see the last 1 year, as of today, the Nifty has written about 17%, but the banking index has delivered only 14%. So why I'm saying this, that sector is not overvalued, right? There are pockets in there where there's significant value, and that's why those returns haven't been as great. So it gives you a good comfort zone. So I would say that as a satellite pick, I would recommend that you choose a good quality BFSI fund, which invests across the cap curve and across, like I said, left hand side and right hand side of the balance sheet. right, as a good pick for the current next year, right? With those few words, let me conclude this. Thank you. Look forward to meeting you in the future.